All right, everybody, welcome into Mining Stock Daily. In this week's long form episode, a little bit of an off week here as I have been traveling with family last few days. And actually, this conversation we were supposed to record Wednesday, and actually a little bit fortuitous that we had some technical connection difficulties on my end, because I'm happy to welcome in Will Thomson of Massif Capital onto the podcast for the first time. And within the last 24 hours, when we first originally tried to do this discussion, some big changes. Silver is broken out. Gold miners are outpacing the metal, and copper is trading up above $5 once again. Some economic data hit the tape the last 2 days, but that non-farm payrolls report out of the U.S. Highly anticipated for tomorrow. So we're going to talk a little bit of macro into the whole thing, but really get into the niche of the resource investment world with Will and his fund over at Massif. So, Will, good to see you. Thanks so much for your time and joining us today.
Yeah, no, happy to be here. Thanks for having
All
me.
right. We're going to cut to the chase. I think everybody wants to talk, what these markets are doing, especially in commodities and resources. But because this is your first time, we got to, give us that 30,000 foot view of Massif and really your approach to these markets.
Yeah, so just for anyone who's never heard me speak before, Massif Capital is a long short equity fund. I founded in 2016. Actually launched the fund in 2019. Focused exclusively on materials, industrials, and energy. Materials is almost always all mining stocks. And it's about a third to 40% of the portfolio, and we sort of invest globally and across both the capital structure and most market caps. So, in terms of sort of more broadly what we're seeing now, I mean, I think I don't know much about silver in the grand scheme of things. It's not a metal that I've actually spent a lot of time with, but of course it tends to follow gold and over the last week or so, I would say, you might be starting to see a little bit of that now, obviously. Um, copper, copper's been stronger than, at least stronger than I would have expected this year for sure, given the significance of China in the sort of global copper ecosystem. Um, But the tariff threats in the United States have obviously created a weird situation. We're waiting on Section 232 outcome for a copper tariff, and obviously that resulted in some weird flows of copper out of China and out of Europe into the United States, creating, I mean, an oversupply or a glut of inventory here and a deficit of inventory, if you will, in other places. Although I did see that China's rebuilding their inventory sort of last week. Uh, so the fact that it has remained this strong, I mean, it comes as a surprise to me. I've got a fairly significant exposure to copper, but I had sort of built it as a long-term sort of investment in the companies,
Yeah.
as opposed to in the commodity. But the commodity is doing a lot of heavy lifting this year.
We're going to kind of narrow down some of these topics here throughout the longevity of this conversation here, Will. But I want to ask you a little bit about kind of, you started this 2016, got Massif launched. How has the investment approach in resources kind of evolved, since that time over the last 9 years? And what are some lessons that maybe you learned and had to cut your teeth on here in the early years of
Yeah.
Massif that, is obviously a good lesson to take forward now that you're, almost reaching double digits?
Yeah, I think that when I first started, I definitely had a tendency to fall in love with assets.
Mm.
Um, and uh, I think there's a lot that a good asset can accomplish a lot. But in the end, the asset is really only as valuable as the management team. And so falling in love with a good asset, uh, say, despite management or in spite of management, um, is a recipe for disaster. And I think that applies not only in mining, but I think in any um, we think about our fund as investing in listed real assets. I think that applies across the board to any business that is about operating a big physical asset. You can fall in love with, say, a really cool like oil and gas operation, but if management can't execute and can't operate it well, it doesn't matter how great it is. The same thing goes for a factory or a manufacturing facility of some kind. So one has to be really careful with that. And I think the very first mining investment I made was actually in Lucara, which is a Lundin-backed diamond miner. And uh, I just thought it was the coolest. I just thought it was really cool. Here's this great, kimberlite deposit that had been overlooked by so many, producing these diamonds that are, the size of baseballs. Um, Very cool, uh, but not a good investment. And the diamond industry, and there's been news about it this week, right? It's like fracturing and falling apart here. It's not a good business for publicly traded equities and things of that nature. And so while it was a really cool asset and we were invested in the stock for like 5 years, um, it just went nowhere. So one has to be really careful with the asset versus the management team, and so I've very much come to prioritize the people over the asset. Not that the asset's unimportant,
Mm.
but so that's a big lesson learned, obviously.
The old
Um,
jockey versus the horse type of debate. Yeah.
yes, exactly. Uh, Another one is that these are not, natural resources are for dating. They're not for marrying. So. I have more than once held too long. And so if you hold the stock too long, it just is going to circle back down to the bottom. And so one needs to be ready to sort of cut bait and get out. And it gets really tricky, I think, with commodity companies because the momentum and the trend associated with the underlying commodity can take over. And so pinpointing when to sell becomes really hard because, of course, commodities can, have a very asymmetric move. You look at something like uranium, or you look at lithium a couple years ago, uh, and people some have heard me talk about this story, but we're invested in Lithium Americas, and it went from a $2 stock to a $40 stock. Uh, in the meantime, they did not advance the project at all. It was all on the back of lithium going from ten to $15,000 a ton for probably lithium carbonate or hydroxide at the time, and to 80, right? And so at the time when it went to 80, everyone was talking EVs, et cetera, et cetera. You could, you couldn't quite see it staying at 80. You knew that was too high, but the idea that maybe there was going to be a long-term stretch where it was at like 40 or 50, um, was a possibility. So how the hell do our valuation done at when the stock was at a $2 stock and lithium was trading at 12 to $20,000 a ton, you know, uh, do we toss that out the window now? Because at 40 or $50,000 a ton, as a $40 stock, it might have been undervalued. So you got to learn to date them. You got to learn to cut bait, and you can't let that trend and momentum from the underlying commodity play too significant a role in your sell
I
decision.
think this is a really interesting discussion. Maybe we should open up here, Will, because where we're at specifically with precious metals, and we can throw copper in there as well, we've seen a real thrust in the equities, specifically with the gold producers. And this week, it feels like they've got another leg upward, and we're starting to see that investment capital kind of trickle down into the developers more, and some of those construction mode type of plays are also seeing big moves in their equities. Some of the top tier explorers also seeing big moves, and so this is the playbook is playing out. But for those like you and I, probably have about the same type of timeline when we first started in this business. Well, you probably were dabbling in this business longer, but with the fund of Massif, you know, Massif and myself about the same time frame. And I've learned enough to listen, like these cycles, they don't last forever. In fact, the rug could be pulled at any moment. So I play when I can, I play my cards and I take some money off the table. And in fact, I did some of that this week with a few of my positions. But then, of course, those positions keep running up, and I'm sitting in the back of my mind, well, I should have waited. I could have had more money in my pocket. But that's just the greed. That's greed sitting in, right? So you've got to take these opportunities. But where we're at in this cycle, it feels like we've got a lot longer to go here. We're still early innings in the precious metal cycle. So talk about that balance between being in profits, knowing that there's money, real money to be had, and kind of shelving the greed and expectation that this thing's going to last another months, years, decades.
Yeah. Um, so I think, look, when we talk about investing, we can have, you can have people who have an information edge, although there are not all that many people who actually have an information edge. You could have a process edge, and so like someone like Citadel or something like that with all their pods and their risk management and all this. They've got this whole big, you know, infrastructure around what they do to execute their strategy that creates edge for them. And then, behavioral edge, the ability to control your own emotions and read through the information that everyone else is reading, but read it calmly and thoughtfully. Um, all of us, individuals or small funds like my own, the only things we really can have is consistently have is the behavioral edge. We can have a little process edge, maybe relative to a retail investor, just being very deliberate about how we go about doing everything, but we can't really have like process edge like Citadel or something. So that management of the behavioral component becomes critical, and even more critical in the cyclical industries that we traffic in, because not only uh, not only is a reset sort of predictable, but we know it's going to happen at some point. Like we just don't know the timeline associated with it. So I do think that being very crystal clear about your behavioral challenges and what you need to do to manage your behavior so that you can be very thoughtful about what you're doing in the markets is critical. In regards to gold right now, I think gold is actually really tricky right now. So 18, 24 months ago, I don't think gold was particularly tricky. You could buy, gold miners and development opportunities and things like that. And they were trading at reasonable discounts to valuations with sort of acceptable gold prices that you could foresee a nice long-term sort of $2,000 gold for the long term, $2,500 gold for the long term. You could buy gold miners trading at discounts. Now, gold has run. Some of the miners have run. They haven't run as much as gold, so there's absolutely some catch up. But now, buying into names, you've got to start baking in a higher gold price. And at least for me and for my portfolio, uh, I don't like to buy a company or a miner because I think there's going to be a higher gold price in the future. There needs to be a company catalyst first. And then if I happen to get the timing right and the environment right with the gold price, well, that's great. That just layers on top, right? But again, our research indicates that, say about 50% of the time, the commodity explains all the price action in an equity. The other 50% of the time, and this is for natural resources companies, specifically mining, the other 50% of the time, it's other variables. But what's really interesting is that those other variables and the commodity price, they rarely occur at the same time. So one year the gold price explains the movement, another year turning on a mine explains the movement, but rarely do you have them both at the same time. And so right now, what you're actually looking for is, we're in a situation where you might be able to find a company where they're both occurring at the same time. But you're really going to have to dig deep at the moment to find those opportunities, because I think a lot of the sector, a lot of people like you and I, the people who have been buying or have been in the trades for a while, we're in them. And the people that are coming in, it's coming in because of gold price being high. And so it's not, it's just a flow uh, elevating the stock price on the back of gold price. And I don't know where gold price is going to go, and anyone who is sitting out there predicting where the gold price is going to go, they may be right. But they're trying to read the tea leaves on central bank buying out of China. They're trying to read the tea leaves on what the United States is going to do with tariffs. Um, I don't know what the United States is going to do with tariffs. I'd be surprised if anyone
Well,
did. So I think gold is really tricky right here.
sorry to interrupt, but I think there's when it comes to like the actual gold miners here, like the expectations of what kind of catalysts are on the horizon, I think is a little bit that's a tricky question because I think the expectations are now that listen, work on your assets, get the mine optimization working, keep the cash flow going. Anything higher in the gold price is obviously gravy on the books, and that's not necessarily a catalyst. So I don't know exactly what kind of catalyst would be expected out of already producing mines, except maybe bringing a new asset online, getting
Yeah.
permitted, or something along those lines. But you can go down the value chain, and that for those expectations. And I posed the same question last week with Rick Rule, and I'm going to ask you this, but I think specifically U.S. focused companies right now, like there's a lot of catalysts that can be kind of anticipated as far as the permitting reform and happenings, the executive orders coming out of the White House. Like, do you feel like there's that kind of leans a better hand for investment for the U.S. specifically?
I think so, but I'm not sure it applies for say gold miners.
Mm,
I mean, what we're seeing now out of the administration is basically we're seeing President Trump come out and say, "I've picked these 10 projects here, and I'm going to advance their permitting really quickly." And we've seen him done that, and then they've come out with another 10. And obviously, this is not literally Donald Trump picking them, but somewhere, in some department, there's someone saying, we're going to name these 10 projects, we're going to name these 10 projects, and then they're going to keep doing that. But these are going to be critical minerals projects. So, at least from my perspective, I think US copper represents something really interesting right now because those companies are going to get a very supportive environment. Whereas gold, I think gold probably benefits, maybe there's the occasional asset that does slip through, but what gold needs to see is they need to see sort of a regulatory change in regards to permitting and whatnot that occurs at the sort of more the congressional level where they actually change the rules of the road as opposed to an executive order from the president. Executive order from the president, critical minerals, gold,
mm-hmm.
silver, those guys probably need the actual regulatory change, which is going to be Congress. And who the heck knows if those guys ever get their act together and make appropriate regulatory changes. But the United States is fantastic, has a fantastic geological endowment, and we need to figure out how to monetize it. We're going to make the steps with the critical minerals, and I see big opportunity in copper, but precious metals less certain.
Have you been able to digest the executive order with nuclear energy that came out of the White House 2 weeks ago? And obviously, we saw the equities get a huge thrust in anticipation of that, and then a little bit of follow through from there. But it also seems, from that standpoint, there's a lot of wind to the sails with U.S. specific uranium stocks and uranium development, and well, obviously, nuclear energy and the utilities coming online. But that's a long term thing, and so I think right now a lot of people are kind of digesting this, and we got to see some tangible follow through. But and I know you a little while ago you wrote a big note on global atomic, so obviously you're invested in the uranium space by some magnitude. But talk about last 2 weeks and trying to get that up,
Yeah.
digesting that.
It, so he signed I mean, I think it was 4 executive orders um, pushing for more efficient licensing from the Nuclear Regulatory Commission. There was one for building a resilient domestic supply chain. Uh, there was one for deployment of nuclear energy, and then I don't know. There was another one somewhere. So he's issued a couple of executive orders. The question of whether they can really sort of reinvigorate the United States, I mean, it's going to depend on the follow through.
Yeah.
So some of the regulatory change to accelerate the build of nuclear power plants is going to be a lot harder than just an executive order. The the sort of risk paradigm for approving a nuclear power plant in the United States is to drive the risk. It's not framed within the context of this is sort of like the level of risk we're willing to accept. It's actually framed in such a way that it's always about driving the risk lower. So if someone achieves this level, whatever level of, let's say risk is ranked on a scale of 1 to 10, with 1 being no risk and 10 being tons of risk. If someone has driven their risk down to 3, the government turns around and says, well, how can you drive it down to 2 now? So it's like this continuously more expensive approach to regulation because, of course, driving risk down further, each step it just gets more expensive. So I think it's going to be a lot harder than just a executive order to change that sort of culture and that dynamic around nuclear power plants. But we have seen them pretty rapidly accelerate some environmental approvals for domestic uranium producers. I'm blanking on the name of who got a permit, but someone got like an
Anfield.
environmental permit.
Anfield.
Yeah, in like 14
Yeah, it was
days.
quick.
Um, and to be perfectly frank, even 14 days is actually, I mean, so quick that I'm a little like, are you sure you actually did the work? Uh,
Right.
I don't want you just like permitting mines without doing
Right,
anything. I
right,
just
right.
don't want you spending 10 years permitting them either. So hopefully they find the right balance. I definitely think we have some uranium deposits in the United States that could be brought online quickly. And I know UEC and UR Energy, and there's a couple of other names who have IRS deposits that could produce some uranium quickly. Um, so I think that's good for the domestic market. We still, those pounds aren't going to be enough globally. All of the deposits, my understanding of the U.S. deposits is that they're mostly small, and it's mostly about cobbling together a whole lot of them,
Right.
as opposed to, say, some of the deposits across the border in Canada, which are, massive deposits who single-handedly can change the global supply demand dynamics. What I will say is that I think globally, the opportunity or the biggest opportunity in uranium right now, again, in my opinion, is people who are actually bringing on pounds over the next 5 years. Everyone else is just going to be trading with the uranium price as measured by, maybe the spot price, maybe the term price, but some, mix of those things there and sort of sentiment. It's the guys who are going to be bringing on pounds, I think, over the next 5 years who have the biggest opportunity to benefit going forward.
Mhm.
Um, because we're really going to see a squeeze here over the next 5 years. And then that 2030, 2035 period, you absolutely get squeezed too, but you theoretically, at the moment, theoretically get a bunch of those Canadian mines coming online and relieving some of that stress.
Well, that
Do they relieve it in entirety? Probably not.
but
But
the
yeah,
dynamic with Canadian uranium coming into the United States and being used is like a whole nother conversation, which obviously needs to be cleaned up. And to be honest with you, I think is a huge mistake that we've even got to this point on so many different levels, not just uranium, on all trade. I mean, they're our biggest partner. How we've got to this point, I think, is just a debacle in itself. But if you can get that cleaned up and you can start feeding what could be potentially huge move in more nuclear energy in the United States. It's going to need pounds. I mean, I don't know how quickly it can come from U.S. operations, but could probably come from Canada as well. So I think that's I think that needs to get solved here pretty quickly in order for this to have that's a tangible thing that would need to be fixed.
Yeah, no, I mean, I think that I'm flabbergasted by the administration's treatment of Canada, given what their stated sort of more global objectives are with critical metals and things like that. Canada, between Canada and the United States, there's very little that we don't have in terms of natural resources. And it hardly needs we hardly need Canada to be the 51st state for us to have a good relationship, a good trading relationship that can benefit both sides in regards to critical metals or energy. I mean, all our refineries down on the Gulf Coast, they need. I mean, they don't all need, but they need that heavy crude from Canada to make the most use of their setup. So it's a real shame where we are, and hopefully we address it because it's an essential relationship. We help them and they help us, and that trade deficit that's not an issue between the United States and Canada.
Let's table domestic conversations here on resource development. I'm based in Colorado. Obviously, you are based in North Carolina. I do want to turn our attention to Democratic Republic of Congo, and I know you have done some investing and also kind of follow up on the Alphamin Resources. That hit the news here. This is a story I really wanted to cover with you because it kind of was a head scratcher for me. They have a new majority shareholder. 56% of the company is changing hands in basically a stock swap. But it's happening at a huge discount. When the news was announced, the swap was at 70 cents. The company is trading at 92 cents Canadian. So they're getting this thing in International Resource Holdings is getting this thing for a song, I guess you could say, based on just the closing price the day before the news was announced. This isn't the sale. Doesn't look like this is a sale, even though the company has talked about trying to find a buyer. Just kind of general sense on, this block trade, new majority shareholder, and if this does anything to help get that sale through a door, maybe find a new buyer after everything that's happened, earlier this spring.
Yeah. I was surprised by it as well. I woke up, yesterday morning and saw it, and I think I was like most people who are a bit surprised by it and a bit confused by it. The information flow, if you will, has still been pretty limited. So I don't think we know all the details of what's going on. I did go back in my notes. There was an article from November of last year saying that IRH, International Resource Holdings, which is a Abu Dhabi, United Arab Emirates sort of entity, had actually been kicking the tires on an investment. But that article, and I think this may be where the 70 cents comes from, but I'm not sure. I don't know, obviously. But that article talked about Denham Capital, who was the owner of the 56% stake and sold it. That article talked about them trying to create a vehicle. So they're a private equity firm. Obviously, private equity firms are having trouble getting rid of some of their stakes in businesses now, regardless of who the private equity firm is, let alone private equity firm with a giant stake in a mine in the DRC. And so they come up on their 10-year limit, let's say, and they need to start returning capital, and they don't have permanent capital, right? And so this article suggested that they were, looking to create a vehicle that would buy the stake and allow them to continue holding it. And they were looking for investors in that entity. My guess is that when they did that, they sort of said to themselves internally, like, how can we transfer this entity at a rate where, we have an opportunity to make a little bit of money in the entity right away, get things going well. Our shareholders in in the private equity firm or the private equity stake that is getting bought out make some money, et cetera, et cetera. I suspect that 70 cents was a proposed price in that transaction within the context of that sort of
Yeah.
structure, and it was favorable for both sides. Um, the same article suggested that IRH was someone who was being looked at or talked to as a participant. And so my guess would be 70 cents was proposed. It's now hard for them to back off that price since they had proposed it to that IRH investing in this entity anyway at that price. I don't know if that made
Yeah.
sense. Did that make yeah. So it's again, it's a little bit of a head scratcher. Um, but I mean, IRH is getting a good deal. Uh, they're also trying to build a trading arm, and I know that the offtake from the mine right now, Bisha is 100% going to. I'm gone, forgotten the name of the trading firm, but there's someone with 100% offtake till 2028. Post 2028, there's no offtake agreement for
Hmm.
100%. I believe IRH is trying to build a commodity trading arm, or I
Oh,
know they are.
interesting.
So my guess would be that they are, they're also interested in perhaps securing that tin offtake. Um, and so they position themselves strategically quite well at very reasonable price. Um, it makes a lot of sense from their perspective.
Yeah.
Uh, I'm not a buyer here per se at 80 cents because I've got a sort of a full position. But if it fell to 70 cents, I would sort of be a buyer again. Um, I also think that they're getting a really great deal. Um,
I would
the more I
say
think
so.
about it, the better the deal. Yeah, I'm going to talk myself into buying it right here live on camera. The more I think about it, the other thing is that the conflict right now between the DRC and M23 is really a conflict between the DRC and Rwanda. And Abu Dhabi, United Arab Emirates, they are big investors in not only in Rwanda, which they view as a bit of a hub into East Africa, but they're big investors sort of across the eastern side of Africa, whether it be buying farmland, minerals, infrastructure, etc. They're big investors across the board, trying to develop in kind of a mimic of China, if you will, trying to develop these deep relationships with these countries with ample resources that they can capitalize on and use their sort of oil and natural gas money to recycle into. So I suspect that this is probably really good also for Alphamin, just in terms of deepening the integration of that area, papering over some of the political issues, getting them out of the way of sort of the economic concerns, and reining in Rwanda a little bit to let this area of the world sort of operate. So I suspect it's a good move, and then of course sitting on the side you have the U.S. Who is making, be perfectly frank, somewhat surprising, amazing progress. And amazing is, of course, relative, but amazing for that area of the world. Progress in getting a peace agreement, if you will, between the DRC and Rwanda and critical metals agreements. Um, it is actually the unheralded success, I think, of the Trump administration that nobody's
Yeah, I don't
talking about.
understand why they're
Every place
not like
else,
ringing the bell on. I don't understand why they're not ringing the bell harder on this one. I mean, I know
I
they're focused
I
on
don't know
stuff in
either.
Europe and obviously the Israel-Gaza conflict, but this is like you've got to you're a win here. Like, why is this not making bigger news?
I agree, and the other thing that flabbergasts me is that Donald Trump's always talking about how many lives are lost in Ukraine and the Middle East, and and he's right about that. There are a lot of lives lost in the Israel-Palestine conflict or Ukraine-Russia conflict. This is a conflict that's been going on for like 30 years, and the numbers of lives lost here
Yeah.
are really huge too. And the number of displaced people is in the millions, and he could really he's always looking for a Nobel Peace Prize. I don't think he's going to get one here because of the DRC, but to be perfectly frank, anyone else who brought peace to the DRC and Rwanda probably would be up for a Nobel Peace Prize. So it's an interesting situation.
Sticking with the DRC, and actually it made me think of this, but I saw pictures the other week with Ivanhoe Electric's Bob Friedland. Excuse me, just Ivanhoe Mines Bob Friedland and Ivanhoe Electric's Bob Friedland. Same person, same Bob. Shaking hands with President Trump in a meeting in Saudi Arabia. So obviously there's some connections being made there. I don't want to rehash the events out of the Kakula underground mine there in the DRC. We've already done that here on the podcast. But what is interesting is we are seeing the copper market run higher now. And as we mentioned earlier in the conversation, north of $5 per pound on the futures. Are we starting to see some of that maybe speculative money come in on less supply because Kakula's remains offline on the mine, although the processing continues to start dwindling down? Is that at all part of this, or are we still kind of waiting to see what the ramifications might be?
So I've been very surprised with the market in the wake of that news. I had thought there would have been more of an immediate reaction, and there wasn't. So that actually surprised me, and I can't sort of wrap my hands around why, today there's a 2.5% move or so in the price of copper, why there wasn't bigger moves then. It's certainly a possibility. They continue to, and I know I think you had Rick Rule on talking about it, and he is going to know the players personally as opposed to me. I just know them, the same way the rest of us do, and he's going to be more involved in it. But it is potentially quite a significant hit to supply, and it is deserving of some recognition and some response in the price of the commodity. So I certainly think here, we may be starting to see that. So, but I couldn't say any more than a speculative yes. But there should be a response.
All right. Big picture here before we start wrapping this up here, Will. I want to talk about kind of just general conversation. Once in a while, I like to pose this question, and I can't do it every week, obviously, because we'd start getting probably the same answers. But the question really remains, are we in a commodity, like not just the metals, but commodities bull cycle? The metals obviously are doing really well. Precious metals, copper's doing well. Some of the base metals are still in the tank, but we've seen some movement out of palladium, platinum again, which is nice to see.
Yeah. Especially today.
Agriculture is a little bit rough on the edges, although beef and hogs continue to move up. Oil is hanging in there by a thread, I would say. There's still some speculation. We've covered that quite a bit on the Oil Ground Up podcast here on ClearCom. I just point listeners to that conversation for the latest. And obviously uranium, the spot price there has been moving up, and that happened before the executive orders. So like big picture commodities, like are we in these early stages of a bull market? Dare I say, I'm not going to say super cycle. I think that's definitely preemptive, but at least a bull market. Like how do you feel about where we're sitting right now?
So earlier in the year, I wrote a report about geopolitics and sort of modern day mercantilism, if you will. And I think that's important for this conversation. So my response is no, I don't think we are. But what I do think we're going to see over the next 10 years is within a more fractious international trade. So I mean, look, the super cycle commodity stuff, what was going on there was, this giant sucking sound from China as it sucked in all sorts of resources. And it didn't matter what kind of resource it was, it didn't matter where it came from. So everything inflated. Yeah. I don't see that happening here. But what I do see happening is periods of boom and bust for various different commodities rolling through the system as the supply demand dynamics run into a lack of investment kind of across the board for almost any commodity that you're talking about, and the drive for self-sufficiency and security by almost every country sort of globally right now. Like, this idea of self-sufficiency, the last 10 years, that was sort of like a China idea. China ran its economy to try and achieve a degree of self-sufficiency and insulate itself from the rest of the world. The US is now doing it. Europe is now doing it. We see, I mean, the DRC's efforts to reach out to the United States to get the critical minerals deal done. That's the same thing. That's them trying to diversify away from China to create, greater economic security for themselves. So what we're going to see over the next 10 years is this continuous ebb and flow, I think, where politics intrudes in very significant ways into the natural resources sectors and drives both further market fracturing, which creates strain and stress on supply chains and probably results in increased prices and a degree of inflation within those supply chains. And countries or companies sort of trying to take advantage of that by playing different sides off of each other and different commodities benefiting from it at different times. And so we're going to see a lot of rolling sort of situations where commodity prices for individual commodities pop and then settle back down as they work out the sort of the new trading dynamics around those
I mean,
commodities.
it's a great setup if you're a trader in commodities. It's a great setup.
Yeah, I think so. But I don't want to I wouldn't suggest that these these pops, these cycles, they can have legs. They're not they're not necessarily day trades or something like that, but months and years. It's not going to be everything all at once,
Right.
or at least I'd be surprised to see everything all at
Well, I mean,
once.
today's a
There
great
isn't that.
example. I mean, we've been waiting for this silver move, and silver popped $1.50 while gold was basically flat.
Yeah, and gold, yeah, gold is still flat. And then there have been days in the past week where, gold and oil were both up at the same time, even
Right.
though, one tends to think oil, more positive economic news, gold, and we're also seeing a change in sort of the demand dynamics, right? So all of a sudden, or not all of a sudden, it's been building over the years, but you look at gold, right? And you see Asia, there's a giant sucking sound over in Asia for gold. Um, the ETF, the suck from ETFs here in the United States isn't nearly as significant as central banks in Asia right now. So you're seeing like changing dynamics. And then China's changing the rules around the Shanghai Futures Exchange um, to try and make it easier for foreign money to trade commodity futures in China. So we're getting these new and look, I don't know whether they're going to have success at that or not, but we're getting these new uh, sort of hubs that are forming around different commodities. And that's going to change the flow and the trend and the cycle around those commodities.
You've got a end of quarter note coming down the pipeline here over the last month of Q2. Here, Will, any thoughts on what you're going to be writing about if you haven't started already?
So I have not started already. I'll save it to the week before the quarter ends.
That's
I won't
proper. That's
start it
proper.
until then. Um, what'll I be talking about? I don't know. It remains a really uncomfortable market
Oh,
in
that's a
my
good way
mind.
to put it. Yeah.
It's very. I wrote something recently about how we always deal with a high level of uncertainty, but we don't necessarily always deal with quite as much unpredictability as we have, right? And so uncertainty you can think of as sort of, you know, well, Kamoa is a good example, right? One could absolutely foresee them having an issue in the mine with sort of engineering and construction.
Hmm.
It just it was going to be really hard to put odds on what it was. That's uncertainty. And you would have put really low odds on it also. Okay, that's uncertainty. Unpredictability is, you know, a tweet from Donald Trump. every morning that changes the market, changes global risk appetite, and you have no idea if that's going to happen tomorrow morning, or maybe it's like I thought there was a week there where Donald Trump was really quiet and markets started to settle down. Right, so you have no idea. So we have a high degree of unpredictability. You have just an Elon Musk tweet. You have no idea. Could you have predicted yesterday that he was going to come out against the big beautiful bill? No. Now that one's not significant, but if Donald Trump tweets that, that's a different story. So we have this high degree of unpredictability in markets driven by the political backdrop, I think. And it makes it a really tricky market where I want to have short exposure, but I also got my face ripped off on short exposure in the second half of April. So now I'm really timid about having some short exposure.
Yeah.
So
Productive and uncomfortable. It's the way
yes,
it's basically summarizing this market right now and resources.
Yeah. So it's hard.
Yeah.
It's hard.
Yeah.
So that's probably what I'll.
Awesome. Well, I think I've just found the title for this episode as well here, so I'm going to use that. I'm going to beat you to it, but I'm sure you're going to get a lot of people reading your note here at the end of the quarter. How can people reach out to you, Will? Inquiries into just kind of your process, your investment, or even inquiring about Massif?
Yeah. So www.massifcap.com is our website. I'm on Twitter. I think it's WM Thomson 22. And we produce a fair amount of research. The research sits behind a paywall, but you can find some samples and on our website. And then we produce a chart book on a weekly basis that covers a lot of stuff that's it's like 80 pages long. It's available for free. It's out there at the moment. So feel free to take a look at that. And if you want to reach out, contact information is all on our website and someone will get back to you pretty quick.
Very cool. All right. Good to have you on. I'm glad we could finally make this happen. I apologize again for yesterday's kerfuffle with technology. But again, I think it was fortuitous that we got to wait a day to get this done because there was a lot that happened this morning. Thanks so much.
And now silver's up and gold is down.
Oh, how about that? See? All right, let's make sense of this. Have a great weekend, everybody. We'll be back early next week. I'll still be on the road, so still a bit of an off week. But again, thanks to my guest, Will Thomson from Massif Capital, for helping me end this week. And we'll talk to you again later. Have a wonderful day. Be well.
You too. Thank you.